Hello everyone. So in a previous video you have seen that the payback period has some problems as an investment evaluation metric. One problem is that it does not discount cash flows. Now to that you might say, well, the discounted payback period takes care of it, and you're right, it does. But both payback and discounted payback period as evaluation metrics have two other problems. If a firm says that, look, we want all our projects to pay us back in 7 years or less, for example, there's a problem with that. One, how did the firm determine it should be 7 years, not 8 or 6? So you can see that this is sort of subjective and potentially subject to manipulation. You could sort of move this around to accept a particular project or reject a particular project. So that's one problem. The other problem is that if the firm says, look, we are only concerned with projects that pay us in 7 years or less, this means that typically you end up not considering those cash flows that are occurring after your desired benchmark, which again, as you've seen in a previous video, can be a problem. So why do firms use payback period? As you saw in a previous video by Dr. Michael McLaughlin, one is simplicity. Payback is simple, it's quick, it's effective, right? So to illustrate that, let's suppose that you're at Home Depot and you're saying, look, should I buy a lawnmower that costs $400? And if you buy this lawn, then you won't have to call your lawn guy to cut the grass and everything, which means that you might end up saving $40 per month giving to your lawn guy. And so very quickly you'd be sitting there, and in less than 5 seconds you'd be like, okay, so what's my payback? My payback is 10 months. Within 10 months, I will recover my initial investment. So it's quick, easy, nice, because you'd be like, okay, am I comfortable with that? And you might just go ahead and buy the lawnmower or not, depending on how you feel about this 10 months. So as you can see, payback is rather simple, quick, and effective. Now, it turns out that payback period has another redeeming quality. To illustrate that, let's suppose that you are a young firm which has just started out, you have great investment prospects, and you're looking at a project, call it Project A. Now, Project A is a big project, right? So this is with like a big client or something. This is probably going to cost you something like $300,000. And because it's a big project, it's going to take some time for it to develop and launch, which means let's suppose that you're not going to make any money from it in the next few years. In fact, the big bucks start coming in really around year 7, where let's suppose you make all of a sudden 500,000, and then the project really starts kicking off. So maybe you get 2 million here, and maybe let's say 8 million here, and maybe even as much as 20 million. I'm just making these numbers up, but the main point is that the big bucks start coming out right around towards, after some years have gone by. Now, you can probably imagine that for reasonable discount rates, this will likely be a positive NPV project, because even if the discount rate is as high as 20% or so, you are making a lot of money. They are more into the future, but their discounted value is likely going to be higher than 300,000. So this project is likely to be a very high NPV project. But you see what the problem with this project is? You spend a lot of money as a young firm up front, and you don't make anything in the middle. You're waiting all this time, so you are strapped for cash over here. Why might that be a problem? Because if you're a young startup, you don't want to be in a position where you're short on cash. You're strapped for cash and you're not able to redeploy any funds in other investments. Now compare that to a situation where instead of Project A, you also have, say, Project B and Project C. Project B, suppose, is a very small scale sort of a project. It will only cost you 100,000, but it will return you your money faster. In fact, let's make some numbers up. Let's suppose that you'll get 50,000 here in the first year, and then immediately you'll make 100,000 in the second, and then maybe even 200,000 in the third. And let's suppose with Project C, let's suppose that this requires an investment of 200,000 upfront, but then it will give you $100,000 immediately in 1 year, 150 here, and then let's suppose in 300,000 over here. You can probably see that these, again, for reasonable discount rates like 10-15% are likely to be positive NPV projects. but the NPV of these projects is not going to compare to this project A. Project A is a big project, right? Here you make the big bucks. So positive, even though all these projects are likely to be positive NPV, and I'm not doing a lot of that NPV math over here, but the main point is this. If you are a young firm with investment opportunities, you might end up rejecting something like Project A, even though its NPV is significantly higher than the combined NPV of projects B and C. Why? Because it pays you back quicker. It has a quicker payback, right? As you can see, Project A doesn't even start paying you back till like year 7. And so my point is that payback period can be particularly useful for those firms which are young but have growth prospects, because it can help generate cash faster, which can then be redeployed into other investment prospects. Now, this is not a rule of thumb, but my main point is that payback period is not also bad, especially young firms with growth prospects would like to consider, at least in addition to NPV, what is our payback? So payback has some good qualities in that regard as well.